The Reserve Bank of India came out with a report last weekend. The internal working group, as it was stated in the report, suggested a change in the corporate ownership of the bank, making it possible for corporates to further own commercial banks. Already, most of them have a stake in NBFCs, which are non-banking financial corporations. But this suggestion, which came through the internal working group of the RBI, suggested that corporates could also go ahead and own commercial banks. Now, in no time, the usual suspects were out, the Raghuram Rajans and the Viril Acharyas. They all were criticizing this suggestion by the RBI. It wasn't something that the government had suggested, but the RBI just came up with this suggestion. The Congress came up with its favorite jai, the Soot Boot Ki Sarkar. But to look at the bigger picture, to look at the debate with a wider perspective, how good or how bad is the corporate ownership idea for the banks, for commercial banks? And to discuss this with me, I have Shri R. Jagannathan, Editorial Director, Swarajya. Hi, sir.
Hi, how are you?
Sir, good. Sir, as you always say, in India, we first need to prove why something doesn't work before saying why something works. So I'll start with the criticism first. Now, the first question I have, that's everyone asking, do private corporates, do they have the trust for one and the free cash to anchor a private bank?
See, first thing, our experience with corporates owning banks, especially before nationalization, has not been good. All those people who are busy lending to themselves and they were bankrupting the banks they own in order to support their own industrial companies and all that. So that was in fact one of the rationales for nationalization, that the money was being, depositors' money was being misused, and sooner or later depositors would have been in trouble. That was one point. Okay. Second thing is, many corporates, especially in the crony capitalism era, misused bank funds. They siphoned it off and even brought back some of their own borrowed funds as their equity and did all kinds of funny things. So general popular trust in companies is poor. So let's accept that reality. However, when you look at what you think, I think not more than 3 or 4 business groups will at this point qualify as being capable of putting in 1,000 crores or more upfront in equity. So I think you will find that the number of corporates who will enter, even if they want to, will be very limited in the initial phase. What we may find is that foreign banks with a lot of equity muscle will be forerunners in this business, which is why we actually need to let in Indian corporates too. Because we don't want to give away our market to foreign fellows merely because they have a lot of equity capital.
Right. So let's assume this goes ahead, this very well goes ahead, as you said. What will be the regulatory relationship like? Because let's say a corporate owns a bank, the RBI would need to have a regulation in place where it makes sure that the lending and the depositors' money is not being rerouted by the company to further its commercial interests. So how do you see the regulatory relationship between RBI and the corporate which owns a commercial bank?
See, the RBI will have to reinvent itself. It can't have that laid back kind of regulation it has had so far. Because if you're going to regulate nimble corporate bankers, then you must have equally nimble regulation. It means the regulatory reach of the Reserve Bank should go beyond the usual small apparatchik sitting in the RBI head office and include a lot of private bankers and let's say forensic accountants who can actually know when funds are being diverted. So the regulatory ambit needs to include more than just central bankers and their supervisory staff, because smart bankers will always run rings around them. So you need to have a better regulatory and supervisory structure before you let them in. But I do think that you must let them in, because the fact that you are a poor regulator does not mean that you should not allow people with the ability to run a good bank should not be allowed. That is your own failures, you're making somebody else pay for it.
Sir, but critics would say to that, I mean, I'll bring in the Yes Bank example from now. You said the RBI should invent itself and there should be better stakeholders who can take care of all the regulation. But let's take an example of Yes Bank. It took an entire change of political landscape. It took a long investigation which went through years to actually figure out what was going wrong with Yes Bank when it comes to their lending practices. Of course, the story is a little different, but the problem was still there, that even to find out a problem within a private bank. It took so many years, a change of entire political landscape. So how would that happen? Say the current political landscape may favor a corporate bank which is indulging in some wrongdoing. So that could be a little problem, and that could last a lot of years. Don't you think so?
No, I don't think so. In fact, the Yes Bank is exactly the kind of bank that the government wants and the Reserve Bank wants. That is no major corporate shareholder. It's always funded by the shareholder. And look where they ended up. They ended up in the sick way of the State Bank of India, right? Whereas if you look at, let's say you take kosher business groups, like say the Tatas. Now, if the Tatas were to run a Yes Bank and they ran it into the ground like this, the group would suffer a reputational risk which Yes Bank did not suffer, because Yes Bank was just Yes Bank. It was not owned by anybody, nobody with any reputation to lose except two promoters who had very relatively small holdings. Whereas think of a Tata or a Birla doing this and being failing. Can you imagine the reputational risk of a Tata's bank failing? Because it will impact the entire group. So I would say that the risks are actually lower on the corporate side than when you have a bank with no great promoters, all general shareholders, and two guys running the bank like they deem, one or two guys running the bank as they deem fit. The risk is higher here because there is no reputational risk.
Right. Sir, now there is also some reports, some media, some experts saying that even if you allow corporates to run commercial banks, when it comes to the lending, corporate owned banks shouldn't lend to corporates, but instead they can be focused on loans to small and micro enterprises. They can be focused on agri loans. They can be focused on micro loans. Do you think that's a valid idea?
See, one way to restrict, say, unwanted corporates from entering the business is to say that they can only do retail financing, which means Tatas will not be able to lend to Tatas or Birlas or whatever. They will lend to home loan borrowers, auto loans guys, some agricultural people, and microfinance institutions, those kind of things. So I think that's one way to automatically restrict the kind of fellows who come with the evil intent into banking. That's one way. The second thing I think you need to know is we are talking about as though corporations are banned from it. If you are going to allow NBFCs to convert to banks, which nobody seems to have an objecting, nobody has been objecting to, including Raghuram Rajan. What does it mean? All NBFCs are linked to business houses. You have Mahindra Finance, you have Bajaj Finance, you have even Kotak Mahindra, they were this thing. So my point is, and then there could be Tata Finance, all those guys are actually corporates. So you are saying NBFCs with corporate backgrounds can become banks, but you're saying corporate should not enter. What kind of stupidity is this? In any case, in the case of payment banks, you have not allowed them, you're not allowing them to invest anywhere except government bonds and short-term paper. So they are already owned by corporates. All the payment banks that exist now are owned by corporate guys like Geo Payments Bank. Earlier there was a Aditya Birla Payments Bank. All those things are there. So my point is, corporates already exist in banking. Now your only thing you are doing is allowing them into universal banking, which is a step ahead. Now, if you can't manage an NBFC, turning it into a bank which is actually corporate linked, what is to stop? Why should you stop a regular corporate from entering the business?
Good point. So that was just bringing me to my next question. Like there are NBFCs, as you said, like Bajaj Finance, L&T, Tata Capital, Piramal Capital, Mahindra Finance. All of them actually cut the threshold for being from going from an NBFC to a commercial bank. But sir, the requirements of a proper bank are very different from that of an NBFC, because there's this cash reserve ratio, there is an SLR. So there's a lot of benchmarks that come into play when you talk about a bank as against an NBFC. Do you think the corporates can live up to that structure? They can thrive in that structure? Because running an NBFC, of course, will be very different than running a bank. Won't it be the case?
Yes, actually, it's easier to set up a new bank than to try and convert an NBFC into a bank. And in fact, it takes several years for an NBFC to convert into a bank, because initially its SLR and CRR requirements will demand so much capital, so much fresh infusion of deposits that it cannot immediately convert. This is what happened, say, for example, IDFC and IDFC First Bank. IDFC was a NBFC, an infrastructure lender, and they floated a bank first, and now there is some talk that they might merge into the bank now that they are 3 or 4 years old. The second thing that actually did, even when ICICI Bank merged, ICICI merged into ICICI Bank, they first bought up another bank, Bank of Madura, so that the liabilities base is large enough to absorb all their assets, so that the SLR, CRR, and CRAR, that is capital adequacy, becomes adequate once they become a bank. So that is the way, and IDBI also became a bank. So they got their own forbearance from Reserve Bank. So my point is, changing from a non-bank structure to a bank structure is a process. It will take several years. So we should not worry about it. And as Sriram Transport Chief said the other day, it's easier to set up a new bank than to actually try and convert an NBFC into a bank. But many people will do that. They will probably first acquire a bank, then merge into it and do something like that.
Sir, there always been all the Raghuram Rajans and all the critics normally, they have actually been critical on one aspect, which is that conflict of interest. Concentration of economic power into few hands, safety net concerns. Now, I went through the RBI report where this entire idea was explained. Even the report raised these concerns that there could be problem of conflict of interest, misallocation of credit, anti-competitive practices. How do you see that corporates and RBI together, working together, can address these issues? And perhaps some people feel that these issues cannot be addressed because the entire supervision would be very, very complex. Do you see these issues being blown out of proportion, the potential problems being blown out of proportion, or are they really a big hindrance to corporates actually owning commercial banks?
See, our problem is, yes, there is a problem of concentration of economic power, but that exists in every industry. Today, for example, corporate power is concentrated in a lot of tech companies. So the only answer is to break them up. So if you have a bank which also owns a lot of businesses, there is certainly a concentration of economic power. But the logical way to do that is to reduce that thing by either breaking up the group or this thing. So we need strong antitrust laws like they used to have in the US, where let's say Standard Oil and all was broken up. Then later on, AT&T was broken up. Then Microsoft was forced to divest certain kinds of businesses. Tomorrow, actually, Google and all will also be broken up if US Congress takes cognizance. We need to do the same. At some point, when corporate interests become too large or too big, you need to break up. And actually, that's happening on its own. If you look at the Tata Group, it's slowly divesting itself of properties and consolidating over 5 or 6 key companies. What is Reliance doing? It is demerging certain businesses. So it will have a holding company structure where there is a Geo platform and a Reliance Fresh retail platform, and there is an oil company. The oil company is being sold probably to Aramco or somebody else or anybody who wants to buy it. So companies themselves find that the large structure is not beneficial for efficiency, and they are emerging. And if they don't do so, by law, you can always force it. So that is something in the future. It is not something that you need to worry about right now when there are no corporate banks, except for few in payments and things. The US actually had this thing called the Glass-Steagall Act. In India, there was never been such an act. All our banks are both in commercial banking and investment banking. We look at State Bank, it has an asset management company, a brokerage, an insurance company, and an advisory services company, a merchant banking company. So they are there in all the businesses. Same thing with ICICI Bank, same thing with HDFC, same thing with Axis Bank. They are all in all businesses from commercial to investment. So we have never had that problem. The reason is the Reserve Bank's rules on lending are very strongly against lending for purchase of shares. Now, the amount of money you can lend against say shares is you need a margin of 50%. That means if I pledge 20 lakhs worth of shares, I can borrow only 10 lakhs. And in the case of banks funding, say brokerages and other things, there are very, very strong limits. So Glass-Steagall didn't apply here because all our banks were both investment and commercial banks.
Right. So now let's talk about the positive aspects because people don't seem to be looking at the positive aspect. I have a few numbers here. If I go from 2000 to 2020, the market share of loans in private sector banks in 2000, it was close to 12.5%. By 2020, it has increased to 36%. If I talk about the market share in deposits, also private sector banks have gone from 12% to more than 30% actually. So of course, there's an inclination towards private sector banks of people as well. Now let's say the corporates come into play. One statement being made by the critics is that you need the public sector banks to run the government schemes and so on. But where do you see, can the corporate banks can the corporate owned banks rather further this inclination towards the private sector, and what happens to the government scheme implementation then? How many public sector banks do we really need at the end?
See, I think if we currently have about six big banks, that is State Bank, then Bank of Baroda, and four banks which are recently merged, 10 banks that are merged into four. Then there are six or seven more of them which are standalone banks. Logically, if as long as the government owns about 35 to 40% of the banking sector's total assets and loans, I think that is enough to push most social sector schemes, because public sector banks typically need repeated infusions of capital because their profitability ratios are much lower. Because they do a lot of social banking, they have to maintain Jan Dhan accounts and other things. Now, we can extend these schemes to private banks, but they will have to bid for it. Suppose you say, I'm going to pay you 400 rupees per Jan Dhan account. How much will HDFC Bank do? Right? So you can do a reverse bidding and say, who is the person or bank, private bank, willing to do social banking at the lowest possible subsidy from the government. So if the government actually wants, it can get even private sector banks to do it, provided it's willing to directly subsidize them, instead of subsidizing them like the backward route of the PSU banks, where they'll first make losses, then you will recapitalize them and compensate them for it. This is what happens with public sector banks. Here you can have a direct subsidy scheme. So it's possible to do social banking even to private sector, provided the costs are done through competitive bidding.
So it brings me to my last question. This is a big suggestion by the RBI. It's not something we can simply ignore or simply let fall prey to critics and so on. Where do you see it can take the Indian banking sector if I talk about digital transformation? Because the Prime Minister keeps talking about digital India. Where do you see can it take the micro lending? Because a lot of people in India, unlike the corporates, do not require loans which go into crores and crores, but they require loans which run into few thousands actually. That's why we've seen a lot of fintech companies come up. So where do you see the role, where do you see the transformation in the banking sector coming about if this idea is implemented, let's say until 2025 or 2030?
Yeah, see, most private sector banks will not get into full-fledged banking. They will start with digital arms and expand branches, ATMs and things very, very slowly. This is what happening in all the new private sector banks, like say IDFC First Bank and others. They're not growing branches like crazy, right? They have limited small size branches, and they have used white label ATMs and various other things. They don't necessarily have overhead expansion the way public sector banks did. So I think they will first expand first in the digital space. Look at a thing like say Paytm Payments Bank. They probably have one or two branches and sitting in Noida or somewhere. But they have something like 200, 300 million customers. Okay, which is nearly half the size of State Bank's customers. Though these guys may be doing much smaller ticket sizes in terms of payments. But the thing is, at some point when they become a small finance bank, they will be able to generate small assets too. So they will be able to do much higher margin asset growth than say public sector banks or who need to get bulk loans. Whereas these guys can make the 1,000 and 5,000 rupee loans for all their thousands of customers. See, what do you need to do? Somebody wants to buy a cell phone for 10,000 bucks. You need to finance 8,000 bucks, right? That fellow will put in 2,000, 8,000, you convert it into an EMI and you've made a loan. And so even if the bad loan rate is as high as 5%, if your margins, if you're going to charge say 12 to 15% interest at a time when the base rates are very low at 7 and 8%, then you're going to make a killing, even if the asset turn substantially more bad than with regular banks. So the future is in small retail loans and small business loans where the margins are very high. So that is where the growth will be. And these digital banks are using fintech support and other things will be able to grow much faster. This is where the lending and borrowing business will work best.
Well, thank you so much for those insights, sir. I hope the ideas which are taking the country forward in terms of the banking sector, they're really implemented and they do not fall prey to what the usual suspects have to say about it. Thank you so much, sir.